Hola mi gente, welcome back to the channel. My name is Sean. This is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, we're going to go over some of the things that you need to avoid when options trading. We'll dive into a scenario that is being played out right now by so many people, and it's probably one of the worst things you can do when trading options. But yet so many people do it, and so many people are going to lose money or miss out on money because they're just not picking the right option. And this stuff is not rocket science. All it takes is a basic understanding of options and how the Greeks work, and you'll see clear as day why this options trade just doesn't make sense. We're going to be doing this on Webull. They have a promotion right now where if you sign up with the referral link down below, you will get 10 free stocks. Webull offers $0 in commissions for options trading, and you can also start trading stocks at 4 a.m. Eastern Time to 8 p.m. Eastern Time. The link is down below in the video description. The stock we're going to be talking about is a stock that everybody knows. This is a meme stock, or as some people call it, a meme stonk. The stock or stonk is AMC, and today you can see was a massive day. It went up 44.91%. It's currently trading at $29.93. Now, what is the worst thing you can do when trading call options? Well, in my personal opinion, the worst thing that you can be doing is buying short-dated or short-term call options that are out of the money. There are many reasons why this just doesn't make sense, and you want to avoid this at all costs. We're going to dive into the math behind this. It's not complicated. It just takes a basic understanding of options. This channel has many videos regarding options trading. There are playlists regarding options trading on Robinhood, on Webull, or just options trading for beginner. So if you don't have a basic understanding, then check out the playlist and the video library of this channel. Now, even though I say this is the worst thing you can be doing for call options, and experts agree, people still do it. If you take a look at this options chain for AMC, the expiration that we're looking at expires in 4 days. It's April 1st of 2022. And if you take a look at the volume and we look at call options for this stock, you can see that the $30 strike has volume of 94,545 shares for today. That's a good amount. Open interest is 11,800. If you don't know the difference between volume and open interest, volume is how many of these options were traded today, where open interest is how many of them are being held, how many contracts are out there, and at expiration, how many can potentially be exercised. If we scroll down on the list and we go further out in the money, meaning that we move up on the strike prices, you can see that volume starts to drop. But the highest volume occurs at the $40 strike. The volume there is 99,000. The open interest is 21,200. This means that this options contract, the $40 strike that expires on April 1st, was the most traded option and has the most contracts out in the market. So this is by far the most popular choice with retail investors who are buying call options, short-term call options in AMC. And this is by far the worst thing that you can be doing. We're going to explain why. There are three main reasons why this just doesn't make sense. The first reason is theta. The second reason is implied volatility, and the third reason is vega. So of that list, you have two Greeks. If you understand how Greeks work, you will then understand why this makes absolutely no sense and why your money will be far better suited in a call option that is in the money or closer to the money. Now let's go over the first reason why this makes absolutely no sense. The first reason is theta, which is also time decay. Time is working against you on this call option because you are far out of the money and you only have a couple of days for this stock to make a huge move. So every day that you hold this, the premiums are going to decrease by theta, no matter what happens with the stock price. If we scroll on this options chain and we get to theta, you can see that it's 58 cents. Which might not seem like a lot because the premium is $2.03, but it's a big percentage of the overall premium. So let's do the math here. It costs you $2.03 in premium. You have to times that by 100 to get the contract because each contract is for 100 shares. So all in, you're at $203. Well, you're going to lose 58 cents per share, times that by 100, so $58 due to Theta. And that's in just one day. So $58 divided by 203, you're going to lose 28% or 29% if you round up in just one day because of Theta. So this stock is going to have to rise fast enough so that you do not lose money to Theta. You're stacking up the cards against you just off the bat by picking the wrong option. Now, if you compare Theta to a different option, one that's closer to the money or in the money, so we went over Theta at the $40 strike, it's 58 cents. If you scroll up and you find one that's just at the money, essentially, the $30 strike, Theta is 56 cents, which isn't a big difference. The difference here is the premium up front. The premium for this one is $3.85. So $56 off of Theta divided by 305, this is 18%, which still sucks. You would hate to lose 18% just because of Theta, but it's way better than losing 29%. And the deeper in the money you get, for instance, if we go to a strike like the $20 strike, you can see that Theta is far less. It's 14 cents, and the premium is much higher. It's $9.80. So the Theta decrease off of this strike is far less, and it's way better if you were to buy this one as opposed to buying the $40 strike. The second and third reason why buying short-term call options out of the money makes absolutely no sense is because of implied volatility and Vega. They work hand in hand. If we take a look at the options chain, the $40 strike, which is the furthest out of the money you can go, has implied volatility of 423.53%. It is the highest of the group. The Vega for this one is 1 cent or 0.01. Now, the reason they go hand in hand is because Vega works off of implied volatility. For every 1% move in implied volatility that you have, either up or down, the premium is going to either go up or down by Vega. So if implied volatility for this position went from 423% and then went to something like 345%, you're going to see a huge decrease because of Vega. You're going to see implied volatility drop from 423 to 345, I believe it was. And then you're going to times that by 0.01. That's going to be 78 cents. 78 cents divided by your entry, which was 2.03 in premium. That's a 38% drop because of an IV crush. And as you can see by this options chain, the closer you get to in the money, the lower implied volatility is going to get. The deeper in the money you get, the lower implied volatility is going to get, and the less impactful Vega is going to be. Check out the $20 strike. Vega is 0.004. Implied volatility is 273.78%. Let's go back to that $40 strike. Implied volatility, 423.53%, and Vega is 0.01. So Vega is not only higher, but implied volatility is also higher, so the chances of that decreasing at a larger percentage is also more likely. So buying short-term call options that are out of the money makes absolutely no sense. And the fact that the $40 strike has the highest volume and the highest open interest just goes to show the mania and the stupidity surrounding AMC stock. If you're buying the $40 call options, it makes absolutely no sense. If you only have $205 to buy a call option A in AMC, there are other things you can do. You don't need to buy the furthest out of the money call option. If you have more than $205 and you're buying multiple contracts at the $40 strike, let's say you're buying 3 of them, so it's worth $600. It is far better to buy an in the money call option. And if you want to risk a little bit more, you want to be a little bit riskier, then buy something that is at the money. And you can still buy 2 of those as opposed to buying 3 of them that are at the $40 strike. Now, if you're that one person that only has $205 and you really want to get in this short-term trade, there are other things you can do. The one thing you can do is you can buy a call debit spread instead. So let's say that you think that $40, it's possible that AMC is going to get to that price. What you can do instead of buying a single option is you can buy a vertical. And what you can do is you can change this to have whatever width of the spread you want. We're going to do a $10 spread. So what you can do is instead of buying the $40 option, you can buy the $30 option and then sell the $40 option against it. And that's going to cost you even less. It's going to cost you $175 as opposed to $205. But there is a huge advantage to buying a spread as opposed to buying a call option. With a vertical spread, you are not going to experience theta decay or an IV crush because you have one option that you bought and then you sold another against it. The theta decay on the option that you bought, you are going to make on the option that you're short. The IV crush, the amount that you lose on the option that you're long, you are going to gain on your short leg. So they're going to cancel each other out and you're not going to lose money like you would if you were to just buy a single call option. And if you click on the option and you take a look at the risk profile, you can see that there is still a lot of money to be made. With a spread, this spread, you would make $121 in max profit for a max loss of $179. So that's a potential 4x on your trade, and you are getting in at a cheaper price and you are reducing the risk or the downside from theta and IV. If you still don't see why buying a short-term call option that is out of the money makes absolute no sense, then I don't know what to tell you. If you have some questions that I didn't answer, you can comment down below. Other than that, I appreciate you for sticking around to the end. This channel does have a Patreon where you get access to a private Discord of over 500 investors. It's where I post all of my trades. Members post their trades on there as well. It's a community where we learn together, grow together, and make money together. A link to the Patreon is provided down below. Do not forget about those Webull promotions, and I'll catch you on the next video. It's been real, it's been fun, it's been real fun, and this is We Are Investing, and together we are invincible. See ya!